Our topic today is indeed the recent tax overhaul. I use those words advisedly. We are going to call it the Tax Cuts and Jobs Act. We are fully aware that that is not the official name. I don't know what the official name is, but you can read about it in the legislative record. And we thought calling it the Tax Cut, formerly known as the Tax Cuts and Job Act, would also not be very efficient. So we're just going to call it Tax Cuts and Job Act. From our perspective, as tax analysts, it's the gift that keeps on giving. We had a conference a couple weeks ago on the impact of the Tax Act on states. That was held at the Urban Institute, and you can find it online. Today we're going to talk about the business side of things. The two of the most innovative sets of changes in the Tax Reform Act occurred on the business side. I don't mean the cut in the corporate rate. That's a big change, but that's sort of a standard change, keeping the simply adjusting the rate. I'm talking about the changes in the taxation of pass-through businesses and the effects on multinational firms and the treatment of foreign versus domestic source income. After that, we'll have a conversation with Richard Rubin. So we're going to pack a lot in this morning, and I think there should be a lot to say. I was going to say that I was going to turn the podium over to Alexandra Thornton at CAP, but I'm not going to do that. She is not here. She's not feeling well, so I'm going to continue on as moderator of the first session on pass-throughs with Lillian Faulhaber at Georgetown, Ryan Reardon from the S Corporation Association, and our own Joe Rosenberg from the Tax Policy Center. So if you guys will come up, we'll get right into the first session. All right, so we have a lawyer, an economist, and a practitioner, and we will start in that order. Lillian, without breaking our minds, please give us a legal overview of the pass-through.
Great, thank you. So up until now, the tax benefit that applied to pass-throughs was not a special rate per se. Instead, it was the fact that they were not taxed at the entity level, and so they didn't have the double taxation of C corporations. But as Senator Hatch mentioned, tax reform effectively added a whole new rate that applies just to pass-throughs that earn certain types of business income. So tax reform added Section 199A, which provides a 20% deduction for these types of business income earned through a pass-through. So with the top rate of 37% that applies to individuals now, this means that that individuals that earn income through a pass-through, and it's this type of business income, have a top effective rate of 29.6%. Now, one thing to note, while this is a noticeable drop from the top individual rate of last year, the corporate rate also dropped down to 21%, which is still below this 29.6%. So the relative appeal of pass-throughs still remains to be seen relative to corporations. But to understand who gets the 29.6% rate, we need to know some terminology that's in Section 199A. So the only income that qualifies under Section 199A is qualifying business income earned by a qualifying trade or business. So what is a qualifying trade or business? A qualifying trade or business is any trade or business other than the following two categories. So the first, employees. If you are an employee, if your trade or business is working for someone else as an employee, you do not benefit from Section 199 capital A. The second category is being in a specified service, trade, or business. That includes investing or investment management, health, law, accounting, athletics, financial services, or any trade or business where the principal asset is the reputation or skill of the employees. So this means that the more tied your skills or reputation are to your business, the less likely you are to benefit from 199A, to simplify that. Now, note that for all of these excluded industries, there is an exception if your income is below $207,500. You end up benefiting, at least in part, from 199A. Once you go above that threshold for a single individual or double that threshold, then if you're in the specified service industries, you can't benefit at all. So what do those specifics mean? Those specifics mean that you definitely cannot benefit if your trade or business is being an employee. If, however, you're an independent contractor, a business owner, or somebody who falls outside of being an employee, then the question is whether or not you are in that specified trade or business. If you're in those specified trades or business, you also can't benefit unless your income is under the cutoff. So what kinds of incentives are built into this definition of a qualified trade or business? Well, shifting away from being an employee, recharacterizing into being an independent contractor or some other non-employee business owner. That's not necessarily as easy as it sounds. There's still the 20-factor test to determine whether or not someone is an employee or an independent contractor. And this also, from a legal perspective, has other consequences beyond just taxes. It has consequences in terms of liability, it has consequences in terms of workers' comp, and on the tax side, it has consequences in terms of Social Security and Medicare and other types of taxes. Now, if you're not an employee, this also creates an incentive to shift away from being in those service sectors and to recharacterize your business. So either recharacterize your business as holding real estate or engaging in some other type of activity, or separating out the aspects of your business that are linked with those non-approved service sectors, and instead focusing more on the other types of businesses that you provide. Or you could do the opposite. Since the focus of 199A is whether or not your reputation or skills are the principal assets of your business, you can try to add more qualifying activities to make sure that your reputation and skills are no longer the principal assets of your business, they're only a minor part of your business. So those are some of the incentives underlying the definition of the qualifying trade or business. The next question is, even if you have a qualifying trade or business, you can only benefit from the 20% deduction if you have qualifying business income. So what is qualifying business income? Qualifying business income, this 199A is a very exception-heavy provision. It's everything except the following things. And the following things are capital gains, to various types of passive income, and reasonable compensation, both to employees and to in the form of guaranteed payments to partners. So essentially, qualifying income doesn't include passive investment income, and it doesn't include reasonable compensation. So this essentially says that if you look at what counts as a qualifying trade or business, qualifying trade or businesses are trade or businesses that are more leaning on the passive side, but the income itself that qualifies is more of the active income that ends up qualifying within those businesses. Now, over all of that, there are other umbrella limitations. So the 20% deduction can be no greater than 20% of your taxable income. So if everything you earn is qualifying business income, then you probably won't get to have a full 20% deduction of that, because it will be limited to your taxable income after you've taken out all of your other deductions. There's also a limitation on the deduction based on how many W-2 wages you pay or the amount of depreciable property that you own. So if you don't pay out any W-2 wages and you don't have any depreciable assets, you can't benefit. But as long as you have one of those, you will be able to benefit from 199A up to a certain point. And then one other limitation that is worth noting is that because this is seen as an individual provision, it expires after 2025. So this is a new way of dealing with pass-throughs that has a short period of time when it is scheduled to exist. So where does this leave us? This means that certain taxpayers just can't benefit. C corporations, by definition, can't benefit, employees can't benefit, and partners or members in pass-throughs whose income is based on reputation, investment, or other services like law or medicine. And even those who can are limited based on things like W-2 wages and depreciable property and the type of income they earn. But this still creates this whole new benefit for the types of pass-throughs that can benefit, and as shown by Kansas, where we had a full exemption based for income earned from pass-throughs, this can create changes in behavior, and this creates distortion. So I was asked to end my presentation with some questions, so I will frame my questions in two ways. First, my first question is in the category of why, and the second question is in the category of what are the effects. So on the why front, we already have a huge number of pass-throughs in the United States. As we all know, since the 1980s, The number of pass-throughs has dramatically increased. The amount of business income earned through pass-throughs is now in the significant majority. And so one question is, do we need to have a special 29.6% rate for pass-throughs? Was the reason for this to reward those companies that had already become pass-throughs, or those individuals who were earning income through pass-throughs, or was it to create an incentive for even more pass-throughs than we already have? And the second set of questions, in terms of the effect, I think you can break into two parts. So first, what is going to be the effect on existing employees? Will any of them switch to being partners or members of pass-throughs, as happened in Kansas? Now, as some of my colleagues, some academics, Diane Ring and Shu Yue, have pointed out, that's not as easy as it looks. There are all of those other legal limitations that I mentioned, and there are so many employees already being shifted to independent contractor status in the gig economy. It's worth questioning whether or not this will change the number of employees who are being shifted into independent contractor status. But then the second part of this question about the effect is thinking about whether or not there are going to be C corporations that will respond. Will C corporations shift to pass-through status, or will the 21% corporate rate be enough to prevent that type of change? So I will leave it with those questions and hand it over to my other panelists, and I look forward to the discussion.
All right, thank you. Before I turn it over to Joe, I was remiss not to mention that if you're following online, we welcome you this morning. And you can tweet or otherwise communicate under the hashtag business tax. So Joe, over to you.
So thanks, Bill. And, so that was a terrific summary of Section 199A, if you missed the official title that Lily gave. As you can get a sense, it's very clear. I assume there are no more questions. What I'd sort of like to do is take a little bit of a step back. I think what Lily made clear is there's a lot to this special pass-through deduction. My view is there's still a lot to be learned about how it will be interpreted, how Treasury and IRS will administer and enforce it. So what I'd like to do is sort of fast forward a couple of years and think about how we will view this pass-through deduction in sort of hindsight, and how we should evaluate it in terms of whether it's good policy or not. And sort of my take on this is sort of best case scenario is it's a large new tax expenditure with sort of dubious policy merit. And that's sort of the good case. There's also a risk that it sort of balloons and that it really proves to be unadministrable and unenforceable, and could in fact be much worse and more of a threat to our individual income tax system. One of the ways we often gauge tax policies is through common metrics of fairness, efficiency, simplicity. So how should we think about this pass-through deduction? In terms of fairness, or who benefits, we have a fairly good handle on who currently reports pass-through income. So currently about 85% of net income from pass-throughs is reported by the top 20% of taxpayers. More than 50% of that by the top 1% of taxpayers in terms of annual income. In the case of partnerships and S corporations, that's more like 70% of net income earned by the top 1%. So while this deduction will benefit, some benefit to a large number of taxpayers, lower and middle income taxpayers that report pass-through income, TPC's analysis suggests that about 50% of the benefit from this pass-through deduction will accrue to the top 1% of taxpayers. So there's little question, just in terms of who reports pass-through income, that the majority of the benefit will go to higher income taxpayers. In addition, it will treat taxpayers with similar incomes very differently. So again, TPC's analysis found that the average tax cut for someone who primarily earns pass-through income would be about 3 times the size of the average tax cut of a wage earner. So it sort of doesn't advance the so-called horizontal equity test. Now, One question is are you willing to sacrifice something on the equity dimension for gains along other dimensions, like efficiency? Will the pass-through deduction encourage pass-through businesses to hire more, invest more, and grow the economy? Here my view is that probably it's positive, yet modest. So you should expect lowering the rate of profits tax might reduce the cost of capital and increase firms to invest a little bit more. But there are far more effective means that, in fact, the Tax Cuts and Jobs Act implemented alongside this, including expanding Section 179 expensing for small businesses and significantly increasing bonus depreciation to 100%, at least for 5 years. So there are probably some gains along the efficiency dimension, but those should be weighed against other costs, again, within the sort of area of efficiency. And in particular, I think as Lily's sort of overview made clear, it really does treat a lot of businesses differently. And so, we probably won't get into the full discussion, and frankly, I think a lot is still to be discovered. But I think Section 199A, or the pass-through deduction, will create a lot of new distortions and exacerbate a lot of distortions related to entity choice, how businesses organize. Do they remain a pass-through entity? Do they try to convert to a corporation or somewhere in between? The last sort of dimension is simplicity, and I won't spend a whole lot of time belaboring this. I don't think there's a case that this improves the simplicity of the tax system. Lest you think I'm too pessimistic or harsh on this provision, remember that's my sort of optimistic case. The so-called guardrails hold. According to JCT, this provision, the annual cost of about $50 billion. So post Tax Cuts and Jobs Act, that's will be a very large individual income tax expenditure, certainly a top 10 individual income tax expenditure, if not top 5. And I think there's a real concern that these rules and these lines that are drawn prove to be quite hard to enforce, and that there's considerable opportunities to game this provision, especially by taxpayers with the highest paid and most talented lawyers. And so again, just as a sort of frame of reference, TPC sort of did a hypothetical, what if there were no guardrails in the provision, so just a straight 20% deduction on all pass-through income. That would increase the cost of the provision by at least 50%, so you'd be talking about a $75 billion a year cost. So just to give you some sense I sort of view the JCT score, the 50 billion a year, as a relatively conservative estimate. Sort of assumes guardrails works and IRS can enforce it. So, I have no doubt that my lawyer and accountant friends will come up with 1,001 ways to sort of game the system, however you want to phrase it, help their clients take advantage of this provision. I don't exactly know how that will play out. I assume that there will be some sort of cat and mouse game between taxpayers and Treasury and the IRS. What I do know is there's a large body of economic evidence that suggests that taxpayers will respond to tax rate differentials in how they report their income. So it's not a question of whether the pass-through deduction will encourage taxpayers and businesses to shuffle their affairs to take advantage of the lower rate, but it's really a question of magnitude and whether it sort of is a manageable tax expenditure, again on the order of $50 billion a year, or whether it's much worse than that. And again, I think really becomes a threat to the individual income tax system. I will probably stop there. I mean, I think to answer one of Lily's question, I think the pass-through deduction was really a solution in search of a problem. It was really more about solving a political problem, which is how do you lower the corporate rate while doing something for pass-through businesses so they support the legislation, rather than an economic case that says that it's based on a real need from either equity, efficiency, or simplicity argument, a real economic case. I will stop there.
All right, thank you. Brian.
Thank you, Bill. Brian Ryan with the S Corp Association. I think I'll start like Joe. Start at a high level and work our way down. First, I'd like to talk a little bit about sort of the value proposition of pass-throughs in general. I think they tend to get short shrift in the tax community. Second, talk about the tax bill that just got passed and the implications for S Corps specifically and pass-throughs in general. And then talk a little bit about where we see things going. As you can imagine, we're an advocacy organization, so our job right now is to figure out, sort of where do we go with the rules that are in front of us. In terms of the pass-through value proposition, I think if we were to start with a blank sheet of paper and say, how are you going to tax businesses moving forward without any pre-existing rules? Many people, there would be certainly a plurality and maybe a majority of tax people on both the left and the right would agree that the pass-through structure, the way that S Corps are taxed, is the correct way to tax business income. You tax it once, you tax it when it's earned, you tax it hopefully at a reasonable rate, and then that's it. And you avoid that double tax that the C Corps have to pay that creates all sorts of distortions in the economy. And frankly, I think that the bill that we just passed is going to increase those distortions. What we did with the bill that just passed is lowered the rate at the C Corp suite, at the C-suite, but we sort of relatively increased the penalty for kicking that money out to your shareholders. So you increase the bias towards keeping the money within the corporate structure, which could lead to tax sheltering in many cases, and less about doing something, making decisions based on what's best for your shareholders for the economy. With S Corp, you sidestep all that. You don't have that second layer of tax. Moreover, when you do earn money, it's taxed at the shareholder's progressive rate. So if you have a shareholder who's low income, they pay a low rate. If you have a shareholder who's high income, they pay a high rate. It's much more progressive. It's much more accurate relative to if we want a progressive tax code, S Corps embrace it. C Corps don't necessarily do that. I find it interesting that, Joe's talking about, who pays taxes and all that sort of stuff. Actually, what he said was who's going to save money. The conversation who actually pays the taxes rarely gets talked about. To jump ahead and answer one of Lillian's questions, there's no doubt in my mind that what's going to happen under this tax bill is more and more economic activity is going to shift out of the pass-through world and back into the C Corp world, which means you're shifting income out of what's properly taxed into the double tax that creates most of the distortions and hurts the economy in the first place. That's not a good result. It also means that the income inequality that Joe's talking about is not going to disappear. It's not like large S Corps, people that I represent, are suddenly no longer going to own the business. They're just going to own it as a C Corp. So all that income's no longer going to show up on their income taxes. So it's no longer going to show up on the income inequality things. This is something that's been written about quite a bit, and it's not necessarily a good thing. So that's the big value proposition. Keep in mind when we talk about why should we get a deduction, why should pass-throughs have been part of the discussion in the first place, over 50% of American people, private sector workers, get up every day and go to work at a pass-through. 57% of them. So when you're talking about what's good for the economy, what's good for Main Street, that's a big part of the issue, and pass-throughs had to be part of the discussion. Moreover, the businesses I represent are literally Main Street businesses. They're out there in the flyover country. And I think there's a value, there's an importance to having economic decision-making spread around the country and not just housed in New York and Chicago and San Francisco.
having people make decisions about hiring investment who actually live in the communities where those decisions are being made and going to have an effect is really important. And I think during the financial crisis, we saw the importance of that. My guys didn't go belly up. My guys didn't over leverage. It wasn't my guys who created the financial crisis. My guys helped be the safety net to stop it and to prevent it from being worse. So that's the value proposition that I'm talking about. The tax bill. I found it interesting that Lillian spent the entire time talking about the deduction, right? As you should have, because it's really complicated. Yeah? I mean, my guys are still trying to figure out what it all means. We spent no time at all talking about the complexities of the 21% corporate rate, right? How much time could you spend on that? Not much. It's 21% rate. You make money as a C Corp, you pay 21%, right? How much do you pay if you're an S Corp? Is it 29.6? Is it 37? Is it more? The way they've structured the deduction is that you get the 29.6 if you're in the right industry, if you make the right amount of money, if the location where you earn the money is domestic and not international. There are other complicating factors that we haven't talked about. We spent a lot of time during the debate over the tax bill talking about the state and local tax deduction, right? C Corps continue to be able to deduct that as a legitimate business expense. During the debate, there was a high degree of confusion over whether S Corps can continue to deduct the state and local tax on income taxes. Raise your hands if you think S Corps can continue to deduct the SALT. Raise your hands if you don't think that they can. Everybody's going to raise their hand. It's complicated, as with everything in this bill about pass-throughs. Where we ended up was if the entity, the S Corp itself, pays the tax. So if it's property tax, if it's sales tax, if you're in one of those states where they actually have an entity level tax or disregard S Corp elections, then yes, you can continue to deduct the state and local income tax. If you're in a state that doesn't, and this is the preponderance of those states do not tax at the entity level, the tax flows through to the shareholder, then you're not going to be able to deduct those taxes. So if you think about it, California, the top rate there is 12, 13%. At a 30, 37% rate, you're talking about 2 or 3 effective percentage points more that S Corps are going to pay just to be located in California or to do business in California versus, say, if they do business in Texas or Wyoming or Florida where they don't have an income tax. It's a huge variation, and it's going to cause problems. It's going to distort behavior. People are going to move out of California and into Texas and some other places. The NIT, the Obamacare tax, right? It applies to S Corps, but only if you don't actively participate at the business. So if you're a passive shareholder of an S Corp, like you'll be a passive shareholder of a C Corp, you got to pay that 3.8% tax. If you materially participate, you work at the S Corp, you don't have to pay that 3.8% tax. So again, you've got a differential based on whether you're active or you're inactive. So the net result is that some of my members will get a 29.6% rate, but only if they're in a state without an income tax that flows through the shareholders, only if they actually materially participate in the business, only if they have enough employment, only if they have enough investment, only if they only have domestic income because international income doesn't qualify for the deduction. It's very, very complicated. Add to that fact that it's all temporary. It goes away. So I have been talking to every single one of my members over the last month or so, and every conversation starts with, so what are you going to do? You're going to be an S Corp? You're going to be a C Corp? Every one of them is running the numbers, and every one of them doesn't really know. Some of them, one of my guys said, it's 80%, 90% chance we're going to be a C Corp next year. And some of our guys are like 100%, we're going to stay S Corp. The two main factors appear to be, one, how much of your dividends or how much of your earnings do you have to kick out to your shareholders? Are you in growth mode, or are you actually spinning off money to your shareholders? And that's something I didn't even talk about, is the fact that if you put everybody in the C Corp world, public companies who can reward their shareholders through the price of the stock and the fact that they can sell it on the markets way over here where the C-suite guys don't even know that transaction took place, have a huge advantage over closely held C Corps, because closely held C Corps don't have the ability to sell stock to reward their shareholders. They have to kick out money to their shareholders. So if you're a C Corp, You retain all your earnings, you get to retain 79 cents on the dollar. If you're an S Corp and you have to kick out money to your shareholders so that they can actually be rewarded for owning a business, because otherwise they're not going to get anything out of being an owner of a closely held or a C Corp, right? If in that situation, you're having to drain money out of the business. It's not a level playing field. That's why S Corps were created in the first place. So going back to the decision tree, my guys, if they're kicking out dividends, they're more likely to remain an S Corp. If they think about selling the business, if there's a potential for a sale 5 years, 10 years down the road, they're more likely to remain an S Corp. But if they're in growth mode and there's no intention to sell the business, they're likely to be a C Corp next year. You're going to see a lot of activity moving from the pass-through world to the C Corp world under this bill. So that's kind of the landscape. What are we up to? As Lillian and Joe made clear, the deduction itself is remarkably complex. It doesn't put my guys on a level playing field. Again, C Corps, if they want to convert, they can pay 21 cents on the dollar. At best, my guys are paying 30 cents on the dollar. That's not level. And then if they have to distribute out even more money to keep their folks happy, they're retaining, 60 cents, 50 cents, 40 cents on the dollar? That's not going to be a level playing field. And so one of our goals is to make the deduction as robust and as clean as possible. And there's so many technical details, it's hard to start. One is where you calculate the deduction. So for instance, if you just have a single S Corp, all your business is located there, then it's fairly straightforward, right? What happens if you have multiple entities and you have losses here and gains there? One of my guys, manufacturer, has multiple entities. It has nothing to do with taxes. It's had everything to do with administrative ease in running the business. So they literally have one LLC sitting over here, and they house all their payroll, all their insurance, their line of credit goes through that LLC. There's no money going in that LLC. The LLC doesn't actually have any operations. It just houses all the administrative costs of the business. So they only have one payroll vendor. They only need one line of credit. Much simpler, right? Well, with the deduction, all the employment's over there. And since the deduction is limited to 50% of payroll, Dan's not going to get the deduction unless he completely reorganizes his business if you calculate it at an entity-by-entity level or if you calculate it at the trade or business level. So one of our goals is to allow grouping like they allow right now under 469 so that businesses can take and group the businesses in a way that makes sense, and then they can get the deduction that they're owed. And the beauty of that is that because the guardrails, 50% of your W-2, there is a hard stop to how much of a deduction they could actually get. It's going to be 50% of your W-2. So there really isn't that opportunity for gaming. And I'll say one last thing in response to something Joe said, or actually Lillian too. There are going to be opportunities for gaming under this bill that I think we support shutting down. I think everybody in this room supports shutting down. But you have to distinguish between the rules that don't apply to people making less than $315,000 a year and the rules to apply to everybody else. Because the rules that apply to everybody else, I don't think they're perfect, but they're pretty good. I mean, there is a certain justice to the wage limit. It means that if you want to get to the deduction, you have to go out and actually create some jobs. We can live with that. The challenge is that there's going to be so much attention focused on what's going on with the people under $315,000 that I think it's going to undermine the value or the legitimacy or the perceived legitimacy of the deduction in total. So that's one of our challenges. Second thing is state and local tax deduction. We are working both at the federal level and the state level to see and make sure that S Corps can continue to deduct that as a legitimate business expense. It's going to be an uphill battle, but I think we can make some traction there. And then I had one last thing to talk about. Oh, yeah, and then just, simply put, strengthen and make permanent the deduction. My guys can't plan under the current circumstances. All right? If you're in growth mode and you're trying to figure out MIS, MIC, what do I do here? Right now under the bill, you can expense your CapEx, right? 5 years of expensing. That's great. But if you're an S Corp, what that means is you're taking income now, creating a loss through your expenses, through your CapEx, and taking the expensing, and you're pushing it out in the out years when the deduction doesn't exist. So you will be taking a deduction now when the rates are low and pushing it out in the future when rates are high. Well, that's not good. we got to figure something out there too. So finally, the last thing is making the deduction permanent. As Joe and Lillian said, the deduction itself very complicated. It's going to be difficult to work through, but we're committed to trying to make it as clean as possible, make it workable for real businesses with real profits and real employees and real investment, the people I represent, and I'm hopeful we can get there.
All right, thank you all. So as a listener, we get that it's complicated and there are inequities. I want to build on Lily's questions at the end, Joe's comment that the provisions are a solution in search of a problem, and your comment at the end that there is some logic to it in terms of you have to have the wage deduction. So my question is just, we can all be critical of the provisions, but just sort of step back, give a charitable interpretation, put on your tax cut advocate hat, and answer, is there an underlying logic to the provisions? Is there, yes, they're messy, but is there some broad, consistent goal? Is it that they're pursuing? Is it creating jobs? Is it keeping businesses in the U.S.? Is it affecting, keeping people in one corporate form or another? Can you see any method in the madness? And let me start with you, Lily, since you knew all the provisions.
Can I see any method in the madness? Let me go through your options. I don't actually think you can argue that it's encouraging paying of wages because of the depreciable asset addition. So it used to be in an earlier version, it used to say that you couldn't get this unless you were paying out W-2 wages, but now you can get it if you have some depreciable assets. So I think the addition of that, there are reasons to have that, but it's not, it moves this away from pure encouraging of paying out wages. I think that if you step back and you take a sort of bigger picture, I can see the argument that if you're going to reduce the corporate rate, you also want to have a lower rate that applies to pass-throughs. I can understand that and I can see that logic. I think the specific guardrails, because of the different ways that they're pushing, I don't see one overall logic. And what I mean by that is that by excluding certain types of industries, so favoring some industries, disfavoring other industries, but then focusing on certain types of income within those industries, I feel as if that's sort of all over the map, and it doesn't seem to have one clear message. I would love to hear if you think that there is a clear message there, that there's a reason to be favoring the industries it is favoring and disfavoring the ones that it's not. If there's, I think that a lot of the guardrails have to do with trying to prevent the shifting of employees, of wage-earning employees into partnerships. I think that's an overall limitation, but I'm not sure that that's a method to the madness. So.
Joe, what is the best possible case you can make for the pass-through provision?
Go, Joe.
No, look, I mean, I think Brian and I agree on a lot. I think all three of us agree on quite a bit. I do think it's a lot of it stems from the pressure that the low corporate rate presents. I don't know if this counts as a optimistic or charitable take on the provision, but I mean it could have been worse. So I mean, look at, the House version of the pass-through deduction, it wasn't even a deduction. I think it started out as a cap on the rate, so it would really only benefit higher income people, and it turned on a sort of, in my view, completely sort of not meaningful or less than extremely meaningful distinction between active and non-active or passive. So I do agree that the wage limit is one of the better guardrails they could have come up with, as you said. I mean, it actually requires some employees that you're actually paying wages to. But in terms, it's certainly the case that this is going to affect different companies differently. I mean, so this is not providing the sort of neutral treatment across entity type. But in terms of sort of level playing field, you do have to keep in mind that there is that second layer of tax on corporations. So even with a 21% corporate tax rate, if profits are fully distributed and subject to a top capital gains rate or dividend rate of 23.8, you're looking at an all-in 40% rate just on immediately distributed corporate income anyway. So, again, I'm not all that optimistic that there's tremendous, real investment in hiring gains that will result from this.
Right. Brian, what's the best case?
A couple things. One, Joe correctly points out there is the second layer of tax. You have to calculate the effective rate of that. I would point out that very few dollars that are earned by a C Corp are immediately kicked out to fully taxable shareholders. In circumstances like that, that business has figured out how to be an S Corp because you can't really compete as a C Corp under those circumstances unless you're a utility or heavily regulated or in a particular industry. In terms of sort of the value of the deduction, I think a couple of things. One, we would have preferred a rate, obviously. I think the challenge with the deduction is that it does have a tendency to be limited. It's seen as a tax expenditure, as a special provision, as opposed to a rate, which is seen as the rate, right? And so you see in this bill examples of that, so many different rules. As Lillian pointed out, you have the specified service companies and the limitation on them. As soon as you create a separate rate for pass-throughs, then you have to have guardrails. And the challenge is, how do you go about making those guardrails so you distinguish between real business profits, things my guys make, and the Newt Gingrich and the John Edwardses of the world who create, an S Corp and use it to block paying, at that case, payroll taxes, in this case, to try to get the deduction. It's not easy. It's something we've struggled with since 1993. We came up with a lot of ideas. Some aspects of them were embraced, others were not. But I do think that, as soon as you go down that path, it just creates problems. And what we're seeing here with the complexity of this rule is that it's going to be, I think there's going to be a long period of falling out where the rules are refined and clarified. I think we could have come up with better guardrails. I think some of the guardrails, like the 50% limitation on wages, it's workable. There's a certain justice to it. Limiting businesses based on what industry they are is problematic. I think politically they didn't want lawyers and hedge funds and folks to get it, but there are law firms that create a lot of jobs. And so what's the difference between a job at a law firm and a job at one of my members who's a manufacturer? It's kind of hard to distinguish it on an economic basis, on a sort of relative value basis. So it's as soon as we went down that road, it's problematic. But we did go down that road, and certainly my task in the next few months is to help make the rules as clear and workable as possible.
All right, thank you. We're running really short on time, but let's take two questions. Bob, first one.
So I'm trying to figure out, Joe, who exactly is getting this deduction in the top 1%. If they're in all the identified service industries, if they're making 400 or more, they're not going to get it. And also, if they don't have much W-2 income, they're not going to get it. So I'm trying to figure out, and passive owners aren't going to get it. So is it active owners of real estate, oil and gas, and manufacturing? I mean, who's getting all this benefit? How I'm trying to think about practically who is getting it.
So I don't think there's a limit on pass. I don't think the deduction is limited to only active owners. But I mean, I think the answer to your question is there are a lot of large pass-through businesses that earn a lot of income. I mean, these are the type of businesses that Brian represents. I mean, it's not just hedge fund managers and other folks up there. They're these are pass-through businesses with real employees and real investment and real profits. And there's a lot of income up there.
Right. It's the limitation is on the type of income. So if you're just getting interest and dividends and similar types of income, the income can't be passive. But I agree that as long as you are a sort of hands-off investor in something that is getting active income, then you will end up benefiting from this.
Yes, ma'am. Okay. The microphone's coming.
Colette Goodman from Goodwin. Sort of two questions. One, do you see the states moving toward changing their tax system so that it will be more business level tax, payroll, and so forth? And secondly, are corporations going to be low-hanging fruit for the states?
I'm not sure I understood the second part of the question. First part, I think every state that has income taxes is going to, over the next 2 years, adjust their taxes based on the bill, all the different provisions in there. And certainly the deduction is one of the big factors. From our perspective, our goal is to increase the ability of S corps, partnerships, et cetera, to continue to deduct state and local income taxes. One of the ways that can happen, as I said, under the bill, if the entity pays the tax, you get the deduction. So one of the ways would be for states to allow an election for their pass-through businesses to pay the tax at the entity level and therefore make it deductible. So we're working with folks to see if that's a viable alternative. So everybody's going to be adjusting based on the new laws. I'm hopeful that some of those adjustments are friendly to pass-throughs. I didn't. And the second part, I didn't.
Well, just given that the federal rate is so low now, and individuals can't deduct it, is that the temptation for states to increase the control?
I think so. I don't know.
All right.
That's a political decision they're going to have to make, right?
All right. Mike Schiller.
I mean, the focus, as Mike Schler, the focus here has been on the difference between pass-throughs and corporations. I mean, I think the real irrationality or the question is that why somebody who's self-employed should pay a lower rate than an employee. Why should an employee of a taxi company pay a higher rate than an Uber driver, or why should a doctor pay a higher rate than an engineer who's exempt from? I mean, it's the employees who are. And in terms of state tax deductions, why should an owner of a pass-through get a state tax deduction when an individual employee doesn't? I mean, I think that's a more important comparison than the pass-throughs versus corporations.
All right.
Yep.
So,
sure. I mean, I think that one way that you could sort of simplify down the distinctions between who benefits and who doesn't is who has control, right? If you have the control that you can recharacterize yourself either as an independent contractor or more likely as an owner of a company, and then you can be earning your income that would otherwise be wages through a pass-through. There are some guardrails, but beyond that, that gives you some control that that employees just don't have. And so that, I think, is a larger conversation about the role of employees in the United States and the level of control that they're given and the fact that they're not the ones who have access to a 29.6% rate, max rate, and that those who do have control are the ones who have access to that.
Mm-hmm. John Sablehouse.
John Sablehouse. So this is for Lillian, sort of picking up on a point you made in your opening remarks, that this trend has been going on for a long time. I mean, the wedge was put in place in 1986, and yet we're seeing it, just an exploding rate prior to the tax law, the shift over to pass-throughs. And I'm wondering, as economists, we think of that, okay, they do it to avoid double taxation and other things. But it seems like there has to be something else that's going on. I wonder what your take on it is as a practitioner and what that means for us going forward. I mean, is it something about the ability to change what is taxable income, to offset positive, what we would think of as labor income with some sort of losses on assets? What is it that's really driving this shift, and what does that mean for us going forward?
Well, I will say that I'm an academic, so the practitioners in the room might disagree that I'm a practitioner anymore. But I think that you're right that there's a much broader story here, and it's not just about taxes. And I'll hand this over to Brian as well to see if he has thoughts about sort of what's appealing outside the tax base to his members. But I think there are two stories that are going on, and there's the lower control story and the higher control story. And the first story is the story about a lot of employees being shifted into independent contracting spaces, and that is tied to a lot of the other legal limitations that go with employee status and the sort of push away from that. And so I think you can see a lot of individuals getting out of the protections of being employees who are now possibly going to fall into this space. But on the fact that the majority of business income is now being earned through pass-throughs in whatever form they are, so S corp, sole proprietorships, all of that. I think that in some ways there's been a greater awareness of both the fact that there are greater liability protections in some of these pass-throughs than previously existed or were previously protected, and the fact that the double taxation has been sort of acknowledged, and that you have very large large entities that otherwise would have been corporations pre-1986 that have now been sort of accepted as being pass-throughs, and it's just become more common. So I'd hand it over to Brian to see if you have thoughts about sort of why that has happened.
Sure. There's certainly non-tax reasons why somebody might become an S corp, stay an S corp, succession planning, ownership governance, things like that. But I think it largely is a tax story. And keep in mind that Congress, we created S corps in 1958, but we expanded the rules, engaged them in the early 80s, in 86, and 96, and 2003, 2004. So this has been an ongoing evolutionary process where Congress has intentionally spread the rules out so that more and more businesses could be treated as S corps. And there's this general perception out there that somehow they're getting away with something. They avoid the corporate tax. Well, I could just as easily say that corporations avoid the individual tax, right? And these days that's pretty significant, right? A C corp you pay 21%, S corp or individual you're paying 37%, right? So each person, each business has to pick its entity and its structure based on what's best for it. But just because people choose to be an S corp doesn't mean that they're getting away with something, or in fact that they're paying less than the C corp down the street. In fact, my guys pay consistently in the 30% effective tax rate. And when you look at sort of the international rules in particular, a lot of these companies that they're competing with on the international front are paying in the teens. So my guys already pay a very high level of tax. Under the bill that we just passed, it's that disparity might even get worse. We'll just have to see.
All right. One last question. My co-director, Eric Toder.
You had to pick him. Yeah.
If we assume that the reason we cut the corporate tax was largely for international competitive reasons, and the reason we didn't cut the individual rate was largely for revenue reasons, or we didn't cut it a lot, and so we have this big disparity. If we didn't have a special pass-through rate, what would you suggest as a way of dealing with the disparity between the top corporate rate and the top individual rate as alternative issue policies?
So the question is, if we accept that there's a lower corporate rate, had we not chosen a lower pass-through rate, what would be a better solution for responding to the disparity between the taxation of pass-throughs and the taxation of corporations? Thoughts on that?
Yes. I'm making sure Brian doesn't have anything to throw at me. But one answer is, and again, a point I think we agree on is, it might be nice to have a single tax system for businesses. So the answer to Eric's question might be that it's actually, it's currently very easy or relatively easy for pass-throughs to elect to be taxed as C corporations. So if C corporations have such a good deal with the 21% corporate rate, pass-throughs can take advantage of that. Now, they may be something they lose, non-tax, through going to the C corp tax system, but I guess that would be one answer. Is the previous code and maintained in the Tax Cuts and Jobs Act is in fact a tax preference for pass-throughs relative to C corporations. Not all C corporations, not all pass-throughs, but I guess my simple answer would be let pass-throughs be taxed as corporations.
Well, a couple things. One, for years we've been advocating for the same top rate for everybody. Anytime you create disparities in rates, you're going to have gaming. And, right now we have created a very large disparity, certainly between individuals and C Corps. But, the different rates, gaming is going to happen. And there are rules that they're trying to create and perfect to minimize that, but you're going to have tax planning around the different rates. So, our position has always been single top rate for everybody and make it a single layer of tax, eliminate the double layer of tax on C Corps. In fact, we supported Senator Hatch's proposal to corporate integration, and I was a little disappointed that it never actually saw the light of day. In terms of, can S Corps just become C Corps? Yes, and many of them will under the new rules, but they're not in a better place. And the economy's not in a better place. And let me just emphasize that, maybe that's, it's the thing to close on for me at least, is, all this tax planning that's going on right now within the pass-through world, and there's a huge amount of it, they're not making investment decisions. They're not making hiring decisions. The only hiring they're doing is KPMG and PwC and firms like that, because they're trying to figure all this out. And until they figure it out, they're not going to be making a whole lot of plans, right? But if they do decide to go into the C Corp world, they're not in a better place, because as a closely held C Corp, you're at a disadvantage compared to a publicly held C Corp. Publicly held C Corps have all the advantages. And so the idea that somehow, they'll be okay, no, they're not going to be okay. And it won't be this year, it won't be 5 years from now, but 10, 15 years from now, you will see more economic activity in the public sector and less in the privately and closely held business sector. It's just going to happen. So those are the challenges that we face. And, I think the C Corp rules and what they did is going to be a very significant positive for the American economy. I think what happened on the pass-through side, best maybe a push, maybe a little bit of a negative. We'll just have to see.
So I think to bring those two together, I mean, essentially Joe was saying tax S Corps like C Corps, and Brian was saying tax C Corps like S Corps. And I think that highlights the fact that I think the main problem here is just that it's creating these distortions based on entity structure or characterization as an employee or certain things where I don't think there should be distortions. And so I think ideally what you would want is you would want to pull back and you would want to say, we want to be able to have similar taxation regardless of your entity formation, regardless of your other legal status. And given that now a lot of pass-throughs have the same types, could have the same types or do have the same types of legal protection as C Corps, it may make sense to actually sort of pull back and reassess why we're putting so much emphasis on the legal form and allowing such differential taxation when we could instead be focusing on who's really earning the money. And that could take corporate integration, or that could take the form of shifting more and sort of shifting the two together. But I think that's not what was done. And I think that the comments here have sort of suggested that from different perspectives, we all think that sort of focusing differential taxation on these formal definitions or formal structures, it caused a lot of the problems that were here. So those would be my thoughts.
All right, great. I want to thank our panelists for elucidating an extremely complicated set of issues. Well, I should say extremely complicated compared to most sets of issues, but perhaps not compared to the next issue we're going to talk about, which is international taxation. So let me just thank the panelists, and we'll get off the stage and we'll move